Wall Street just punched through the roof. The S&P 500 closed above 7,500 for the first time in history. The Dow Jones blasted back over 50,000 points. The Nasdaq screamed past 26,600. And in roughly 6 weeks, investors have added over $10 trillion in equity value. 10 trillion, with a T. If you blinked, you missed the biggest melt-up of the decade. But the real question is far more dangerous. The S&P 500 and the Nasdaq just notched 6 straight weekly wins, the longest streak either index has seen since 2024. 84% of S&P 500 companies beat their earnings estimates last quarter. Cisco rocketed 13% in a single session. Klarna jumped 16% on its results. Nvidia keeps adding multi-trillion-dollar weight to the entire market. The bulls are running so hard, they're starting to ignore traffic lights, red flags, and basic gravity. So here's the trillion-dollar question on every screen in Manhattan tonight. Is this the start of a brand new bull market that runs deep into 2027? Or is this the dot-com flashback that nobody on television wants to admit? Because right now, the same indicators that screamed before the year 2000 crash, before 2008, before every painful drawdown in living memory, are all flashing at the exact same time. Let me walk you through it. Start with the Shiller-Cape ratio. As of May 8th, it sits at 40.1. That number has only been hit at one moment in modern history, the absolute peak of the dot-com bubble in late 1999. Then there's the Buffett indicator, which compares total market cap to GDP. It just printed 232%. Warren Buffett himself once said anywhere above 200% is playing with fire. We are torching the gasoline. Famed bear Michael Burry, the man who called the 2008 housing crash, just dropped a brutal new warning. He says today's market structure looks alarmingly similar to the late 90s tech mania. Economist Steve Hanke is louder still. He believes the AI rally has lifted equities into outright bubble territory, where price has decoupled from earnings. Capital economics is even more specific. They predict the bubble pops in 2027. That gives us maybe 12 months of fireworks left. But, and this is critical, bears have been screaming for 2 solid years, and the bulls keep printing money. So what's driving this monster rally? One word: artificial intelligence. Nvidia alone has added more market cap in the past 12 months than the entire GDP of Germany. Microsoft, Apple, Meta, and Amazon are now collectively worth more than the entire stock market of every European country combined. AI is not a sector anymore. AI is the market. Then add a second engine. Earnings season just delivered the strongest beat rate in 3 years. 84% of S&P 500 companies topped analyst expectations. Margins are expanding. Forward guidance keeps surprising to the upside. Goldman Sachs is forecasting 12% earnings per share growth in 2026 and another 10% in 2027. That is not a recession profile. That is a profit explosion. If those numbers actually land, every valuation worry on Wall Street gets blown straight out of the water. Wall Street's biggest banks are racing each other to hike their forecasts. Goldman Sachs sees the S&P 500 at 7,600 by year-end. Morgan Stanley just lifted its target to 8,000. Mike Wilson's team at Morgan Stanley is now calling for 8,300 in the next 12 months, a 12% upside from here. JP Morgan, UBS, Yardeni, every major shop is racing to the upside. Nobody wants to be caught short. There is also a hidden fuel source nobody is talking about. Money market funds still hold over $7 trillion in cash. That mountain of dry powder is sitting on the sidelines watching every new record close, terrified of missing the rest of the move. The moment those funds start rotating into equities, you get what traders call the melt-up acceleration phase. That is the phase where stocks rip 30% in 6 months. That is what 1,999 looked like. Now let me flip the script, because the warning signs are stacking up just as fast. The Federal Reserve quietly slipped a new statement into its most recent minutes. Officials warn that rising oil prices could force rate hikes back onto the table. Oil, rate hikes. 2 words that historically destroy bull markets. At a fresh military flare-up in the Middle East, at a renewed exchange between the United States and Iran, the geopolitical risk premium is rising fast. And here's the brutal part. The rally is freakishly narrow. 10 stocks are doing almost all of the heavy lifting. Strip out Nvidia, Microsoft, Apple, Amazon, Alphabet, Meta, Tesla, and Broadcom, and the S&P 500 is barely positive on the year. The equal weight index, the one that gives every company the same weight, is dramatically lagging. That kind of concentration is exactly what we saw in 1999 and 2021. Both ended in tears. Both ended fast. Small caps tell an even darker story. The Russell 2000 is still trading below its 2021 peak. Regional banks are weak. Consumer staples are flat. Housing affordability is at a generational low. The economy that millions of Americans actually live in does not feel like a record-high stock market. It feels stuck. That divergence Wall Street up here, Main Street down there, is one of the most reliable late-cycle warnings the financial world has ever recorded. So let's connect the dots. AI mania, record valuations, narrow leadership, geopolitical risk, a Fed that may not cut, a bond market sending mixed signals, and a CAPE ratio rivaling 1,999. Every single ingredient of a textbook top is now on the table. But, and you have to respect this, earnings are real, cash flows are real, AI productivity gains are real. This is not pets.com. The companies leading this rally print billions in actual profit. That is the difference everyone overlooks. In 1999, the leaders were burning cash. In 2026, the leaders are vacuum cleaning cash. Nvidia generates over $90 billion of free cash flow a year. Microsoft mints over $80 billion. Apple over $100. These are not dreams. These are dividend machines. The premium investors are paying may look extreme, but it sits on top of arguably the strongest corporate earnings power in American history. Calling this a bubble may be wrong. Still, valuation always matters in the end. The Shiller Cape at 40 has, historically, been followed by 10 years of below-average returns. Not a crash necessarily, but not the moonshot we just had either. Goldman Sachs itself, even while raising targets, says the next decade of S&P returns may average just 3% annually. 3%. After inflation, that is essentially zero. That is the math the bulls do not want printed on screen. But it is real. And then there's the option market. The volatility index, the VIX, is hovering near multi-year lows. Insiders are selling at the fastest pace since 2021. Margin debt just hit a fresh record. Retail investors are piling into leveraged single-stock ETFs at levels that make veteran traders nervous. Every metric of speculative excess is blinking. Every textbook says when complacency is this loud, the floor is closer than the ceiling. But every textbook has been wrong for 2 years. So what should you actually do with all this? First, do not chase. The single worst time to buy aggressively is right after a record-breaking run. Second, do not panic sell either. Calling the top has bankrupted more brilliant minds than any other trade in history. Third, focus on quality. Free cash flow, real margins, durable moats. The names that survive when the music stops are the ones that print profit through every cycle. Boring, but bulletproof. There is one more wild card. The 2026 election cycle. Markets historically rally hard into and out of presidential elections, then volatility erupts the following spring. If history rhymes, we get one more wave of strength, then a correction in early 2027. That timing lines up almost perfectly with the capital economics bubble burst forecast. Coincidence? Maybe. Pattern? Maybe. Either way, the next 12 to 18 months may be the most important stretch for your portfolio of the entire decade. Now here is the part nobody on Wall Street will say out loud. Even if this is a bubble, bubbles often go further than anyone believes possible. In 1999, the Nasdaq doubled in the final 12 months before collapsing. If today's rally has even half that energy left in the tank, the S&P could touch 9,000 before the next major drawdown. That is not a prediction. That is what historical bubbles tend to do. Up and to the right? So we are stuck between two extreme realities. Reality 1, earnings are real, AI is real, and this rally can keep climbing. Reality 2, valuations are stretched, leadership is narrow, and every late cycle alarm is ringing. Both can be true at the same time. That's exactly what makes 2026 the most fascinating market year in a decade. The smartest investors right now aren't picking a side. They're sizing positions to survive whichever side wins. Here is the only thing that matters now. If the S&P doubles from here, do you have enough exposure to feel it? And if it crashes 30%, do you have enough cash to survive it? Because the next 12 months are going to write fortunes and erase them. So tell me in the comments, are you all in on this rally? Or are you finally getting cautious? Hit follow because the next move will decide the entire decade. If this video brought you value, hit like, subscribe, and share it with a friend. Thanks for watching. See you in the next one.